Every stock has two prices. The one on your screen right now, and the one that actually matters. The gap between those two numbers is where every dollar Warren Buffett has ever made came from. Today, I am going to hand you 3 formulas to calculate the only price that matters, intrinsic value. If there is one skill that separates real investors from everyone else, it is this: the ability to look at a business and figure out what it is actually worth. Not what the market says. Not what some analyst on TV shouts. What the business is truly worth based on the cash it generates. Benjamin Graham taught this concept in the 1930s. Warren Buffett turned it into the greatest wealth-building machine in history. And today, I am going to break down 3 different methods you can use to calculate intrinsic value yourself, from the simplest formula to the gold standard used by professional investors. This is educational content, not financial advice, but if you stick with me for the next 10 minutes, you will walk away with a toolkit that most investors never learn. 0.45 to 3.30. Let us start with the simplest method. Benjamin Graham, the father of value investing, gave us a formula in The Intelligent Investor that you can calculate in 30 seconds. Here is the formula: take the earnings per share, multiply it by the book value per share, then multiply that by 22.5, and take the square root. That is your maximum fair price. Now, where does 22.5 come from? Graham believed a stock should never trade above 15 times earnings and never above 1.5 times book value. Multiply those two limits together and you get 22.5. It is a ceiling, not a target. Let me show you how this works in practice. Say you are looking at a company earning $5 per share with a book value of $30 per share. You multiply 22.5 by 5 by 30. That gives you 3,375. Take the square root and you get roughly $58. That means Graham would say this stock is worth paying up to $58 for. If it is trading at $45, you have a margin of safety. If it is trading at $80, walk away. The beauty of this method is its simplicity. You can screen hundreds of stocks in an afternoon. But here is the limitation: it works best for stable, asset-heavy companies. Banks, manufacturers, utilities. It does not work well for technology companies where most of the value is in intellectual property that does not show up on the balance sheet. Graham himself used this kind of approach to find bargains in the 1950s and 1960s, buying stocks trading below their net current asset value. He called them cigar butt stocks. One last puff of value before you throw them away. 3:30 to 7 o'clock. Now let us move to the most powerful method in investing, discounted cash flow, or DCF. This is the method Buffett has described as the only logical approach to evaluating the attractiveness of investments. The concept was formalized by John Burr Williams in his 1938 book The Theory of Investment Value, and the principle is elegant. A business is worth all the cash it will generate in the future, brought back to present-day dollars. $1 next year is worth less than $1 today because you could invest that dollar and earn a return. That is the time value of money. Here is how it works step by step. First, estimate the company's free cash flow. This is the cash left over after paying all expenses and reinvesting in the business. Second, project that cash flow forward, usually 10 years. Third, choose a discount rate, your required rate of return, typically 8 to 12%. Fourth, discount each future cash flow back to today's value. Fifth, add up all those present values. Let me show you why this works with a real-world example. When Buffett started buying Coca-Cola stock in 1988, he invested roughly $1.02 billion. At the time, Coca-Cola's owner earnings were approximately $828 million, a figure documented in Robert Hagstrom's analysis in the Warren Buffett way. The company had been growing that cash flow at 15 to 20% annually over the previous 5 years. Even using conservative assumptions, a 10% discount rate and just 10% annual growth going forward, the discounted cash flow analysis showed Coca-Cola was worth significantly more than the market was pricing it. Buffett saw a business with the strongest brand on earth, selling in nearly every country, with pricing power that let it raise prices every single year. That $1.02 billion investment is now worth over $25 billion, and that is before counting the billions in dividends Berkshire has collected along the way. Now, DCF is powerful, but it requires good judgment. You are making assumptions about future growth rates, and small changes in your assumptions create big changes in your final number. If you assume 12% growth instead of 8%, your intrinsic value estimate could shift by 50% or more. That is exactly why Buffett insists on a margin of safety, only buying when the market price is well below your calculated intrinsic value. 7 to 10 o'clock. The third method is perfect for companies that pay reliable dividends, and it is the simplest of the three to actually calculate. It is called the dividend discount model, or the Gordon growth model, named after economist Myron Gordon, who formalized it in 1962. The formula is this: take next year's expected dividend, and divide it by the difference between your required rate of return and the dividend growth rate. That is it. Let me show you this with a real example. Johnson & Johnson is one of the greatest dividend machines in corporate history. It has paid and increased its dividend for over 60 consecutive years, making it a dividend king. As of early 2025, Johnson & Johnson pays approximately $5 per share in annual dividends and has grown the dividend at roughly 6% per year over the last decade. If you require a 10% annual return, here is the math. Next year's expected dividend is $5 times 1.06, which gives you 5.30. Your required return minus the growth rate is 10% minus 6%, or 4%. Divide 5.30 by 0.04 and you get $132.50 per share. That means if Johnson & Johnson is trading below $132, this model suggests it may be undervalued based on its dividend stream alone. The dividend discount model works beautifully for mature, stable dividend payers. Coca-Cola, Procter & Gamble, Johnson & Johnson, utilities, real estate investment trusts. These are businesses that generate predictable cash and return it to shareholders year after year. But here is the key insight that ties all three methods together. No single method gives you the perfect answer. The smart approach is to use 2 or 3 methods on the same company and see where they converge. If the Graham number says a stock is worth $55, the DCF says $60, and the dividend discount model says $58, and the stock is trading at $40, you can be fairly confident you have found genuine value. When the methods disagree wildly, that is a signal to either dig deeper or move on to the next opportunity. Here is what I want you to remember from today. Intrinsic value is not a single precise number. It is a range. And your job as an investor is not to calculate it down to the penny. Your job is to figure out whether a stock is trading significantly below what the business is actually worth. As Benjamin Graham wrote, you do not need to know a man's exact weight to know that he is fat. Use these 3 methods as your toolkit. The Graham number for quick screening. Discounted cash flow for deep analysis. And the dividend discount model for income-producing investments. And always demand a margin of safety between the price you pay and the value you calculate. If this breakdown was useful, hit that subscribe button. I release a new investing lesson every single day. Tomorrow, we are diving into the most common mistakes investors make when calculating intrinsic value, the errors that cost real money. Drop a comment below and tell me which of these 3 methods you plan to try first. This is the Daily Investor. I will see you tomorrow.